Okay, next up we've got Ryan Gentry, Multicoin Capital, building lightning businesses. Welcome, Ryan.
Hi, everybody. I'm Ryan Gentry, the lead analyst at Multicoin Capital, and I'm here to talk about building lightning businesses and specifically what kind of businesses that could be kind of venture scale returns over the next 10 years built on Lightning. But before I get started, I want you to read this quote from, Titan of industry and potential Terminator, Jeff Bezos. Because it kind of forms the thesis of the talk, which is, to build a venture scale business on Lightning, it's you want to solve problems that are still going to be problems for a large majority of people in the next 10 years. Because that's, like he says, that's a business strategy around the things you can build that are stable in time. So the way I'm going to walk through this is I'm going to first start with, looking back at the last 10 years of businesses built on Bitcoin, how Bitcoin found kind of store value protocol market fit, what trade-offs Bitcoin had to make to find that, protocol market fit value, what kind of venture scale businesses were built solving those trade-offs, and then looking forward, Bitcoin's kind of medium of exchange, protocol market fit, and what trade-offs that will require, why and how Lightning will grow to produce kind of venture scale users, and then what kind of businesses will solve those problems and what an exit will look like for a Lightning Network business. So first, I'm sure everybody in the room is familiar with this chart, right? To become a unit of account, kind of the process to become a money, you start off as a collectible, you move into a store value, you move into a medium exchange, and you finish as a unit of account, right? The Nick Szabo, origins of money, all that sort of stuff, I'm sure everybody is familiar. So when we look at Bitcoin specifically, right, early on it started as a kind of collectible for nerds to mine on their computers, right? Satoshi said, it might make some sense just to get some in case it catches on, right? As kind of like a hint that maybe this could be a store value if more and more people buy into it. But Bitcoin was kind of engineered with these certain properties, its cap supply, its inflation schedule, its stock to flow, as Plan B has showed us, that made it a really, really good store value, right? I look at Bitcoin as a digital commodity, right, that just so happens to have great store value properties. So as we move forward, we started seeing, some real evidence that Bitcoin is acting as a real store value, right? Going forwards into the last 4 or 5 years, this chart on the left is from 2016 from Chris Berniski, showing kind of the USD CNY pair reacting to Bitcoin outflows, right? Where people in China and in Hong Kong were using Bitcoin as a store value, protecting against currency risk, and the PBOC had to react. The chart on the right from Useful Tulips, which Matt Alberg just posted, I think a month ago, shows BTC volume across all of these countries, and you notice when you look at them, they're countries, modern Western countries or modern Eastern countries with really high tech populations like the USD, like China, like the UK, and then it's a bunch of countries with really bad currencies, right? Where people are in areas with really bad currencies are shorting their local currency basically and going along Bitcoin, right? They're using Bitcoin as a store value. So we're starting to see this trend happen, and I think the best possible evidence you could get comes from our friend Jerome Powell, who said in front of Congress that people are using Bitcoin as a speculative store value, right? That's the Fed chairman of the head guy of the USD. He's the final boss. So him admitting it, I think, is great evidence that in the last 10 years, Bitcoin has really found great protocol market fit as a store value, right? And I know everybody in this room knows that, but I wanted to kind of set that stage because that will inform kind of how we look forward for the next 10 years. So the traits that Bitcoin has that makes it a good store value are, you can see on the left, right? It's really verifiable, divisible, scarce, censorship resistant, unfortunately costable, and decentralized. But there are a couple things that it's not maybe great at, right? It's not very fungible, as we know. It's not very portable in that settlement takes 10 minutes. It's much more portable than gold, but not as portable as fiat. It's not very durable. There's not really much we can do about established history. That just takes time, as does durability. But there are some deficiencies that Bitcoin has as a perfect money, right? So Nick Carter wrote this great article called "How Bitcoin Bites the Bullet," and he specifically examines these deficiencies that Bitcoin has and says, you know what, like the creation of a store value asset required that these deficiencies be made, that these trade-offs be chosen. So, the examples he has, and I'll walk through, are, the managed or unmanaged exchange rate, uncapped cap supply, infrequent hard forks, non-discretionary monetary policy, and the bounded block space. So if we look at each of those, right, in order to fulfill censorship resistance, there had to be no third party controlling the supply of money, which means an unmanaged exchange rate, which causes the problem of price volatility, right? Same thing with scarcity. In order to have provable scarcity, you had to have a cap supply. To have a cap supply, Satoshi chose the UTXO model, which leads to a lack of fungibility, and bearer asset key management with public-private key pairs, right? Which is a problem. That's a problem for a lot of people. Same thing, unfortunate costliness causes proof of work mining, which is a problem. It's decentralization means lack of programmability, and et cetera, et cetera. You guys can read the rest. So these are problems that I think can be solved and were solved by venture scale businesses. And before I get into specifically what they are, I want to talk about for a killer app, or for a store value, there's kind of two killer apps, right, for money. It's earning it and holding it, and I guess speculating on how many people want to earn it or hold it. If you're building for the sovereign individual, right, everything open source, compile, everything for binaries, make your own ASICs by hand, all that sort of stuff, that's a worthy goal, right? But it creates pain points. There are a lot of people that will extend a little bit of trust to have those things done for them, right? With enough users all experiencing those same pain points, that creates a market that can be solved by a venture scale company. So these deficiencies that I talked about on the previous slide, price volatility, proof of work mining, all that sort of stuff, there were a lot of people who felt the same pain points and were willing to pay large companies to solve those problems for them. So now we look at some of the venture scale businesses that were built solving these problems, right? Price volatility. If you would have known 10 years ago that Bitcoin would still be here and would be huge and would still have price volatility, you probably would have built an exchange, right? And they made a ton of money. That would have been a phenomenal venture investment at the time, right? Chainalysis, although maybe we don't like them all that much, if you would have known that Bitcoin still would have had bad traceability and bad fungibility 10 years ago, and that people would pay you to solve that problem for you, you would have invested in Chainalysis. Coinbase Custody solved, and Zappo and a bunch of other custody providers have kind of solved key management for people, for high net worth individuals. Permissionless proof of work mining, right? Had Bitmain not gone down the Bitcoin Cash route and had successfully IPO'd, that would have been a phenomenal venture investment, right? They solved proof of work mining in terms of building ASICs and selling them and mining themselves and operating mining farms for a bunch of people. And finally, Bitfinex, right? The same thing with proof of work mining was miners need to sell. They need a liquid market with which to sell. Providing that market to a bunch of miners, solved a big problem for a lot of people and allowed them to capture a lot of value. Unfortunately, I couldn't come up with examples for the last two, but c'est la vie. So moving forward, the one caveat to this was in the last 10 years, buying and holding Bitcoin provided better returns than just about any of these investments, right? That's kind of the fat protocol thesis that all the value accrues to the base layer. I don't know if that's going to be the case for the next 10 years, right? You look at the chart here and it shows the time it took for Bitcoin to 10x in price. And the first one was 11 months and 1 day. The next one was a year and 3 months. The next one was a year and 10 months, then 2 years and 6 months, and projected to be another 3 years and 7 months, right? It takes a lot of capital, a lot more capital to go from $1,000 a Bitcoin to $10,000 a Bitcoin than it did from 10 cents a Bitcoin to go to $1 a Bitcoin, right? So as we continue to increase and as more people store their wealth in Bitcoin instead of in their local currency, I think we will start to see the returns from holding Bitcoin get lower and lower, and potentially the returns from the businesses built on top of Bitcoin outpace them, right? So that's kind of setting the stage from what can we learn from the last 10 years and how can we apply it now to the next 10 years. So for Bitcoin to move into its next stage as a money, to become a medium of exchange, I think that the features that need to be solved, the traits that need to be improved, are fungibility, portability, divisibility, and debatably programmability, right? And in order to not harm the store value properties on layer 1, all of that has to happen on layer 2, right? That's kind of the basic thesis. So if we look at the different kind of layer 2 attempts, or the different attempts rather to make Bitcoin a medium of exchange, we can see there's other options other than Lightning, right? Bitcoin Cash, unfortunately, harmed verifiability, it harmed censorship resistance, and it harmed decentralization by the choices that it made to try and become a medium of exchange. That's not going to work, right? We look at the Liquid network. The Liquid network obviously keeps the same verifiability, very high fungibility and portability with low block times and confidential assets, but maybe is not as decentralized as the base layer Bitcoin, right? TBTC, like atomically swapping Bitcoin onto a synthetic asset on top of Ethereum or Cosmos or some other chain, right? Like that might be more portable, it might be more programmable, but it's not going to be more decentralized, it's not going to be more verifiable, and it's going to be like just as fungible and not as censorship resistant, right? So then we get the Lightning, and the great thing about Lightning is it's verifiable, it's fungible, it has all these great properties, and the ones that it doesn't improve on are established history and durability, which are just that's just kind of is going to take time to work. So moving forward from here, what design choices does Lightning Network have to make to achieve these properties, right? So in order to achieve portability and censorship resistance, we want instant settlement. In order to have instant settlement, we need to have funds kept in hot wallets, and we need to have funds kept in non-custodial hot wallets. In order to achieve fungibility, we need all payments to be private by default. We need onion routed payments. And in order to do that, the problems that it causes, routing and liquidity management, is hard. If you can't see channel balances, it's hard to route payments, as we've seen from the liquidity presentations this morning, right? In order to achieve divisibility, we need a free market for routing fees, which means that multi-hop payments are going to be hard as well, and routing node revenues are going to be low. In order to be verifiable and scarce, we need fully collateralized, which is probably, from the finance guys, like their biggest problem with the Lightning Network is that it's all fully collateralized. And the problem that causes is capitally inefficient, right? People are used to margins and rehypothecation and fractional reserve banking, and we don't want that in a Lightning Network. Finally, to be openly programmable, we need client-side validation, which is a new programming model and with like no tooling built for it yet, and you're going to see some more about that this afternoon. So briefly, why and how Lightning will grow. I think the biggest change in Bitcoin over the last 10 years is how hard it is to earn, right? In the early days, you could mine, on a CPU in your house and make, hundreds of Bitcoin an hour, right? That's not possible anymore. Mining has gotten professionalized and corporatized, and the little guy is kind of squeezed out. There's also the governmental focus on fiat to BTC choke points. It's really hard to earn BTC or to get BTC at all without KYC. So I think the Lightning Network's killer app is allowing people to once again earn non-KYC Bitcoin, and specifically, that is informed by the idea if Bitcoin is the store of value of choice, and if Bitcoin is to become the money of the future, everybody's going to want to earn Bitcoin, right? Like if you don't want Bitcoin now, you're just you haven't gotten to the point yet where you're going to want to earn Bitcoin in the future, right? So if everybody wants to earn Bitcoin, I think the Lightning Network is the best way for people to do so. And these people that start demanding, I want BTC for my work, will act as sinks on the network. And this is like a source sink network where you demand Bitcoin, you pull BTC through the Lightning Network to your node or to your address or whatever. And these earners could be, game developers, which I didn't put into this slide deck, but I've seen a ton of game developers this week that changed my mind. Game developers, bloggers, podcasters, creators, people that are providing liquidity, right? Anybody that wants to earn Bitcoin online will want to earn it through the Lightning Network. So, if you'll excuse my chicken scratch here, this is kind of like the slide. The picture on the left is a view of like what the current legacy payment stack is, right? So if you start from the earners down on the bottom left, the merchant has an independent sales organization like Stripe and a merchant acquirer like First Data, who then are their interface with Visa, the card network, who is then the interface with Chase, the card issuer, who is then the interface with the actual cardholder, the purchaser, me. There's these 3 to 4 intermediaries in between the merchant and the actual purchaser, all of whom take fees up to about like 3% on fees per transaction, and all of which the fees the merchant has to pay, which is key, right? So the merchant has to pay these fees in order to receive payments. What Lightning could do is remove all of these intermediaries, right? And just have the merchant, go to your Lightning service provider or Lightning Network as just a black box, and get directly to the purchaser and cut out all those fees. So it is a better deal if the merchant is willing to accept Bitcoin. It is a better deal for them to accept Bitcoin over the Lightning Network. And we'll see, you kind of see over there on the side, there are like watchtowers as providers. I think I drew this on the board like 6 months ago or something, so my thoughts have evolved. But there are other people around this ecosystem that could help out. So One thing that I think is really interesting here is this is a tweet from Alex Bosworth a little while ago when he talks about, my Lightning node earns enough to buy me Bitcoin every day. And this is a funny example of like this well-known psychological fact or theory called the curse of mental accounting, which is when you earn money for free, like a gift card or something like that, you're much more willing to spend it than if it's money that you earn from work that you budgeted for. If you don't have like a budget for this money where you say, I'm going to use this for this, you're much more likely to spend it. So like everybody knows, right? Like Alex, if you were being really disciplined in low time preference, like you should have stacked those sats, dude. Like you shouldn't be spending this on coffee, right? But it's very easy to say, well, like my node just kind of earned this for free, and so yeah, I'm going to go spend it on coffee, right? So I think that's a way that people will get much more willing to spend Bitcoin on the Lightning Network as if it's something that they've earned rather than something that they've bought and invested their money in. So I'm moving very slowly here, so I'll try and pick this up. Similar to the previous slide that I had, the killer apps for medium of exchange are earning it and spending it, right? Building for the sovereign individual is a worthy goal. It creates pain points. With enough users, those pain points create markets that venture scale businesses can solve, right? So if the Lightning Network is going to continue to grow, we will have these pain points that venture scale businesses will solve. And now I'm going to kind of walk through and do the really embarrassing part where I make some predictions. But hopefully in like 10 years, deepfake technology will be good enough that I can just kind of like massage all of this out of it. So problems caused, hot wallets. You can manufacture and sell hardware to give useful and reliable hot wallets to people. You can do watchtowers and mobile wallets to solve the problem of hot wallets. And I think kind of the network effects that you can get around these to build defensible businesses are brand, and then the hardware software integration, right? Like you look at Apple, they provided the Macintosh for the internet. I think we could maybe see an Apple type business get stood up providing the device that's the entrance to the Lightning Network, right? Liquidity management is hard, right? The network effect is liquidity managed. The more liquidity you have, the more easily you can solve problems for people that have liquidity. So you look at, there's two kind of solutions to that. Custodial wallets as a service, which we look at OpenNode, right? And non-custodial liquidity management, which I think is a much better solution, which Lightning Labs is doing with loop in and out, and maybe some more features that they'll talk about later. Multi-hop payments are going to be hard. Routing node payments are going to be low. We look at Lightning service providers like Breeze and Bitrefill and Eclair and Async and all of those who are trying to solve this problem for people. I think that's a great business, but probably pretty competitive. And I don't know really how long that stays a problem with AMP, Interledger, L2, and channel factories. I think it will be a problem in 10 years, but maybe not. And I think that for the second one, I really liked Lisa's presentation yesterday about liquidity markets, because I think allowing these routing nodes to earn additional sources of revenue through markets for their latent capital, their storage, their compute, and their bandwidth, which we're seeing a presentation this afternoon from Dr. Orlovsky and Giacomo from Pandora Core AG. That are talking about this, and there's DeFi ads is a good way of kind of advertising your latent compute storage and bandwidth on the Lightning Network. Then with capital and efficiency, which the network effect again, solving this problem is having the liquidity and the capital in order to solve it. We look at Thor channels like Zap and Bitrefill, which are doing a great job of solving this problem today. Like I really think though that there will be a market for kind of shorter term loans via Lightning Network channels, injections of liquidity that people will want and will be able to pay money for. And I think everybody's going to have this problem, and that you'll be able to build a great business around solving it. And then finally, client-side validation. If this is the new programming model that people will need to build applications on top of Lightning, the network effect there is building the tools that all the developers use and will be willing to pay for. So Truffle is kind of the example for Ethereum where they have 1 million downloads or something in a couple of years. Who's going to build that for client-side validation? So finally, exiting here is always the main concern of a venture capitalist. How do I get my money at the end, right? You could see companies from Lightning Network, IPO on NASDAQ. You could see them being acquired by Web 2.0 company, fintechs, or an exchange. We haven't really seen anybody attempt this yet, but I think like the security token IEO on Liquid might be an interesting thing that may happen in the future. And then RGB Network, which again you'll hear from Maxim and Giacomo this afternoon. Maybe we could see a return of ICOs if they make sense and aren't illegal security sales. Finally, there's a lot of really exciting things on the horizon, right? Schnorr signatures, Taproot, L2, et cetera, et cetera, et cetera. But I really think that the companies that are going to be built that are solving pain points that will still be around in 10 years. And if you're interested in solving those problems, call me. we're looking to invest. And yeah, thank you for listening. Thanks.